for joining us today. We're for this month's Tenant Talk. We're going to be talking about kind of pathways to home ownership, from lease to where you're able to buy. And we're with two lenders that I've known forever. They're both with Academy Mortgage. It's Kyle Torgerson and Dave Loescher. So thanks for joining us today, guys.
Thanks for allowing us to be part of your deal here.
Okay. Well, we'll go ahead and just kind of get turned into it. They've helped numerous people go through in your guys' situations and help you to be able to buy a home. So without further ado, we'll turn it over to Kyle and Dave and what they have to say.
Awesome. Derek, do we have the share function? Do we share our screen?
Do you see where you can claim host?
There it is.
So yeah, claim host and then
here. Awesome. Well, Dave, do you want to introduce our branch and then I can go from there?
Sure, I'd be happy to do that. Yeah, we're Academy Mortgage, Cedar City, Iron County, Southern Utah, whatever you want to refer to us as. And we're a lender that is a nationwide lender. We're a mortgage bank, and what we are is direct with Fannie Mae and Freddie Mac. And what that means is that we loan our own funds. We're not a brokerage loaning other people's funds and working with other people's underwriters. What Academy Mortgage does is we loan our own money, and it makes us really nimble, and you can get direct answers when you talk to Kyle or myself, and we're going to be able to not answer something on a third party level. It's kind of more direct. And we try to make it as personable as we can. So anyway, Academy Mortgage is actually headquartered in Utah up north, and we're in I think 49 of the 50 states now. So we have got a ton of branches across the states. We can cover most anything, but we, like I said, right here in Cedar City, right on Main Street. If you know where Smith's is, and you know where Pizza Hut is, and you know where AT&T is, and you know where we're at, because we're right there between those three, right there off of Main Street. So Kyle and I have been working together at this for a few years together, and both of us have been in this industry for a long time. Anyway, Kyle and I are both loan officers here, and are happy to help in any way. And we're going to talk to you guys today about a bunch of the options that are out there and financing 101 in general for first-time home buyers. So again, Kyle Torgerson, I'm Dave Loescher, and I think with that, we'll let Kyle kind of run with this and share his screen a little bit and show you guys some things.
Yeah, I appreciate it. So one of the common questions that Dave and I always get is from first-time home buyers, what do I have to do? What do I have to do to be pre-qualified, and what does that really mean? And so this presentation is going to kind of entail all of those questions and answer all of what those are, and hopefully provide a little more insight as far as other loan programs that are available as well, especially for first-time home buyers. And so with that, I'll see if I can figure out how to share my screen here. Host disabled, participant screen sharing. Derek, how do I claim?
You see in the right-hand corner where you can do claim host. Do you have that ability?
I don't see it.
All right, let's see here. Let me get Sarah back on. Sorry.
Oh, you're okay.
Right, screen share. Okay, Sarah logged off. She's like, it's looking good. And then, we got cocky. There's something I can do on my end. Settings. So. Hey, Kyle, if you, well, let's see, it's not even gonna let me because I can't claim host. Give me 1 second. In the meantime, Carrie, do you have any questions? I saw you just hopped on. Or Karina, sorry.
just trying to get used to my setup. So, but okay, so there's the rent to own option. So are there options not with the unit that we're living in, or is it only for where we're living?
As far as rent to own, you mean?
Yeah.
Yeah.
So
So,
go ahead, Derek.
yeah, I was gonna say for your unit, there's no rent to own option.
Oh, okay.
So rent to own is kind of tricky. Typically, what that would translate to is that you and your seller or rentor are they're keeping track of what your rental payments are, and there's agreement of how much of that or of all of that is going to be applied towards the reduction in the purchase price. For example, if you're buying a home for $250,000 and you're paying, and the seller is giving you 100% for your rental payment. After a few years, maybe that translates to, instead of $250,000 worth of purchase value, you're actually down to 115 or 200. And at that point, you're essentially buying that home for that cheaper amount. Is what I've run into in the past. It's really difficult on the mortgage side to give you credit for like a down payment for rents that have been put in. And so, yeah, it's very difficult that way. But what I've done in the past in those situations is it just translates into a cheaper purchase price. That way it does, in fact, give you credit towards your purchase at that point, if that makes sense.
Okay, so do you guys have a list of properties that are applicable for that rent to own option? Or
On us, none of our owners do rent to own.
okay.
It's going to be a case by case with the seller, unfortunately. Yeah.
It's very it's very uncommon. We don't see a lot of that, only because, especially when you're in it kind of fluctuates and ebbs and flows with the current real estate market. When people that own a lot of properties, if properties got to the point where there wasn't a big demand, like lately, if a property goes on the market, it sells pretty quick. It's just been a hot market. So that likelihood of a rent to own option is very, very low in a time like this, because a seller could flip it, sell it fast. But if we get into a tightening loan market again, or excuse me, a seller market, then we start to see a little of that reemerge, because it might be a way for a seller to be able to, get that property sold by allowing their current tenant the opportunity to buy through a contract like Kyle just explained. So I would expect maybe something like that to come back online, if the market starts, the pendulum swings that way.
Oh, okay. Yeah, I just saw stuff with the email saying about that. I'm like, okay, I'm kind of interested then, maybe.
Yeah.
But okay, I'll just wait for things to change on that.
Well, and there's still ways, Corinne, like the point of this, presentation. So there's plenty of stuff as you're doing as a renter, as you're going through the terms of your lease, that you can stop prepping. Just, stay a renter for the rest of your life, just kidding. So that you can start prepping to be able to buy that home, whether that process takes you 1 year or 2 years. But that's the point of this one, is to be able to hopefully to do that. So
yeah. So all right, well, I'll keep my eyes open then and see if things change.
Well, and what we're hoping is that at the end of this presentation, it will give you some options. Rent to own is an option. It's a rare option, but we've got some other options for zero down and sometimes zero cash to close, meaning that you don't have to come up with any funds. So, if that's a concern, we might be able to alleviate that with a few options here. Yeah,
that would be nice, because I sold my house to pay for my divorce, and so, but that we split that money and pay for a divorce, it goes pretty fast. So now I'm, starting at ground zero, and market here in Cedar is like insane.
It's a little difficult, but it's correcting, albeit slowly. It is correcting.
Yeah.
I think the biggest thing, if I can say this real fast, is in your case, where you kind of feel like it's a starting over of sorts, as Kyle mentioned, programs with little money out of pocket to no money out of pocket. I think the
Mhm.
biggest thing that you can do is to utilize those programs, obviously, is, you come out of a divorce situation and credit might not, maybe you're able to keep the credit in good shape. If not, it would be, totally behoove you to do the things you need to do to build that credit up. And if you ever need advice on that, we can certainly help in that regards as well. And I think Derek also has some ability to help with that too and give recommendations, but we have professionals that can help with the credit repair because
Yeah, I'm doing pretty good. It's like credit card use has been a little bit heavy this month or this year, so I gotta pay that down and then I'll be good again. But
good.
yeah, so it's just
All right.
catching.
All right, Kyle, see if you can share now. We made you host. We got everything. Hopefully.
Did that work?
Yep, I can see it. Corinne, can you see it?
Yes.
I can see it, Kyle. You're looking good.
Fantastic. Okay. Well, we'll get rolling here. And so this is a presentation. We wanted to break it down into easy steps where we could kind of illustrate exactly what it's really going to take to become qualified for a home loan. Again, what that means, and then what the underwriting and closing really looks like of a home loan. And so with that, we're going to go through all these steps, 10 steps, but there's 11 there. The last one is just simply we're done. But anyway, to move on to our first step here, we want to talk about the important roles of who actually plays a role in helping somebody purchase a home. Obviously, the first person that's involved with that is you as a purchaser. And what that really means, and we're going to go through that. A lot of times people will hire a real estate agent or realtor to help you in the process of buying the home. There are some contracts and legalities that go with buying a home. Agents usually play two different roles. If you're selling a home, they'll be the listing agent. They're the one listing your home for sale. But of course, when you're buying a home, you're going to be hiring an agent to help you on that end of things. And then, of course, you have a mortgage lender, such as Dave and myself, to be able to help you through those processes of getting a mortgage. There are multiple steps to getting a mortgage, and having been able to do this for a number of years. Dave, I think you're up to 28 years.
Unfortunately, yeah.
Yeah, and I'm about 18 or 19 now. And so we've been in the game. We've seen lots of scenarios, and we can certainly help people get through these processes. We've helped a lot. But the first step, and you'll hear this from real estate agents, you'll hear this from all sorts of lenders, is that you got to get pre-qualified. And that's a buzzword that you hear quite a bit in the market. You got to get pre-qualified. You need your pre-qualification letter. But what that means is that we simply have you do a mortgage application. An application will allow us to assess your credit. Your credit score is derived from your credit history and what's been reported to the 3 credit bureaus. We'll look at your income and take a look at your full-time, part-time income, and also your employment history. Essentially, we want to make sure that you can afford the home that you're applying for, or the loan that you're applying for, as well as all your other bills. And then we're going to look at your assets, which include money in your checking and savings accounts. Most loans include money that you have to come to the table with, whether that's just for your closing costs or your down payment. But like we mentioned earlier, sometimes there are some options where you don't need to have some assets, but we're going to take a look at those and see what you can afford, because we ultimately don't want to create a bad scenario for our clients so that they default. That is not what we want to do. We want to be able to help everybody own a home and be able to afford that home the best they can. But pre-qualification letters or the pre-qualification process, it helps us work with you to determine how much home you can actually qualify for. It actually allows you to increase your bargaining power when negotiating with a seller. For instance, if you are trying to buy a home for $250,000, but you want to, submit a slightly less offer, we can say, maybe you qualify for 215 or 210. That way, you can use that letter to negotiate a cheaper bargaining price so that the seller believes that you can only qualify for a certain amount, when in reality you can qualify a higher amount. We want to be able to work with you to estimate what your monthly mortgage payment is going to look like, and we're going to dive into monthly mortgage payment a little more in a few slides. But aside from that, we're going to try to figure out what loan product meets your needs the best, and that's going to be a function of what your down payment is, what that payment needs to be, and what you qualify for. And again, we'll dive into that a little quicker here. A few things in the pre-qualification process you're going to want to do, and some things you're going to want to stay away from. First of all, on the do side, please call us if you have any questions. And this is again referring to after you've done the loan application and we pre-qualified you. Things you're going to want to do. Continue living at your current residence. Continue paying your mortgage or your rent. Please don't stop doing that. Use your credit as normal. Keep working at your same job, and please don't quit your job. Keep your same insurance company. If you own a home, you're going to keep you have insurance on the home. It's easier if you just simply keep that same one. Stay current on all your existing accounts, and so be the best client you can possibly be for your creditors. Expect requests. And so one of the things that we do while we're doing this mortgage application and loan process is we're going to get some information to provide to our underwriter. And again, we're going to go through those things a little further in the future, but you should be checking your email, should be looking for messages from your lender to remind you of things that have been requested or new things that are going to be requested. The things to stay away from: don't make any major purchases. Don't buy a new car. Don't buy a new boat. Don't even get a new credit card. Don't change your bank accounts, and don't make any large adjustments in your balances in your accounts. Don't close any credit cards. Keep everything the same as what you're pre-qualified with. You're going to want to not consolidate your debt into one card, because it does cause an issue where there's a timing and paper trail where we're going to have to find out what happened with those balances exactly. Home Depot's got a 10% off to your purchase if you get a new credit card. Don't do it. Same story with Kohl's, TJ Maxx. Don't get a new credit card, because that will set you back. It'll make things a little more difficult. And don't max out your credit cards in any way unless it's an absolute emergency. But going back to item number 1 on the do list, if you have any questions, call us and we can coach you through it and help you. Moving on with your home search, which is the funnest part, honestly, usually, is to look for a new home and find the one that you want, that fits your needs and your family's needs. And your real estate agent is going to be really key to helping you do that. They're going to do a lot of back end work looking for the home that you've described to them and in the price range that you're looking for. And so you're going to want to kind of communicate really well with your real estate agent about what your home purchase really means to you. They're going to negotiate for you and try to get you the best deal possible. They're going to also help you avoid any pitfalls, kind of like the don't side of things on the previous slide. They're going to help you understand a few things that you're going to want to not fall into in buying a home as well. They should respect your opinions and decisions. We've got really great agents in our area. Iron County is really blessed with that. And so, the agents that we have here are really going to take really good care of you. And they have a fiduciary responsibility to protect you and your rights. All right. After we complete the loan application, kind of going back to that paper trail of items that we're going to have to collect for our underwriter, we're going to be looking for evidence of your pay. And so pay stubs, usually for the last 30 days, we're going to look at W-2s and possibly tax returns. We're going to ask you about your residency history over the last 2 years. Any longer than that doesn't matter, but we're going to have to document at least the 2 years of residency history. We're going to look at any outstanding loans and credit cards, and you should expect questions about what those are. We're going to be looking at your last 2 months of bank statements, and what that does is allows us to kind of get an idea any large deposits or things that look a little questionable. With those bank statements, they're not going to simply look at a credit history or a deposit history. And so you want to include all the pages of your bank statements so that they have all those items available to them. We're going to get information about your property that you're buying. One of those things we're going to do, and again, we're going to talk about it here in a little bit, is we're going to get an appraisal to help us understand what that property is, if it fits into our lending guidelines, and make sure that it's an eligible property for us to land on. And then there may be other documents that are needed, just simply depending on what your situation is. Everybody's different. And so there isn't a one size fits all. And so these are the most common things that are needed, but you should expect that there could be other items that are needed.
Hey, Kyle, can I say one thing real quick?
Absolutely.
And on that left side of the screen that Kyle's sharing right there, you know, the pay stubs and some of your residence history and your bank statements. Yeah, you're going to basically list that on the application. But one of the nice things with technology today, and Kyle and I have both seen this, we've been in the industry for so long, is the way technology works now is we're able to kind of streamline and simplify some of that for you, in the sense that you submit your application, we run the pre-approval, pre-qualification, and once our processor starts working in your file, they're able to do a lot of things with your, like your bank statements can be digitally obtained as far as your balances and stuff, your W-2s, or I mean, excuse me, your pay stubs. We can actually get a VOE, which is a verification of employment from your employer. And some employers, if they're big enough, they will actually, they make it very, very streamlined and very, very simple. So some of the things, although we do obtain them, can be automatically obtained with your authorization. So it's just, it helps make it look so less daunting, if you will. So that was all I wanted to say.
Oh, that's perfect. And Dave and I have had plenty of loans where all we simply need is, hey, can we get a copy of your driver's license? And that's it, you know, and because we're able to get a lot of these items electronically, it can make the process really, first of all, really quick, incredibly easy. And so, Dave, thanks for jumping on that. Okay, so in a nutshell, there are really 6 types of residential mortgages. Conventional is you're going to be your run-of-the-mill fixed rate and adjustable mortgages, but you have to put money down on those. That typically is what people refer to when they're getting a 30-year or 15-year loan. It's commonly known as a conventional mortgage. Now, these other mortgages also include 30 and 15-year loans, but they are primarily government-based. And so we have our FHA loans. They require less money down, but they still require some money down. USDA loans, these are great programs. They're affordable loans that are government-backed, and they are zero down type of loan. But they're primarily geared towards rural areas. And unfortunately, Cedar City is kind of on the edge of losing that rural definition for our situation. I think that we could be losing that rather soon, unfortunately. VA loans, these are primarily for veterans and active duty military, and these have really great terms and interest rates to help aid and support our veterans. Renovation loans, this is a really great way to buy a fixer-upper and use some loan funds to help get it to a livable state or remodel something that meets your family's needs. Then there's state housing like Utah housing. These are great as well because they usually require little to no money down. And so these are just a few basic types of mortgages that are quite common. In our area, we do a lot of conventional mortgages, a fair amount of FHA, and then we do a lot of Utah housing. But we do have, we can do veterans loans and renovation loans as well. But yeah, those top 3, conventional, FHA, and Utah housing, are kind of our main go-to in our area lately. Interest rates. Everybody's seeing interest rates kind of be all over the place, but primarily up, unfortunately. And that's with our Fed funds rate, with our conventional credit card rates and the home equity lines of credit rates, and then unfortunately mortgage rates as well. The ebb and flow, just like everything else, they go up, they go back down, which is very normal. But interest rates are calculated primarily based on the market. But we do look at your credit, and we also look at the home you're trying to buy and the down payment that goes along with that. It's a really hard question that Dave and I get quite frequently, usually multiple times a day. Hey, what are rates today? We looked at 6 different mortgage programs just a moment ago, and rates for those are all different, and everybody's credit scores are all different, and people's down payment situation is different as well. And so what might be a rate for this person is going to be higher or lower than this other person's. And so that question is rather difficult usually, but we usually try to give a range to try to give people an idea of where things are at, but the actual interest rate is going to be very dependent on your application and the property that you're buying. Anything to add to that, Dave?
No, I think that's good to point out. It's like that loaded question, like you said, is what are rates today? And there's really no short answer for that. And really the biggest driving factor on this that we can't, and it's kind of why I brought it up earlier, is your credit score. In our case, it's called FICO. A lot of you may look at Credit Karma. In Credit Karma, you check and it gives you an idea of kind of what your credit score is, but there's a difference between credit, consumer credit, and what is called FICO, which is something that mortgage lenders pull. It's a little bit of a different model. Your credit score one day via Credit Karma might be different than what a FICO score is. So, but either way, the most important thing you can do is make sure that your payments are made on time, and that you try hard to keep your credit cards from being maxed out. Those are the 2 biggest things that drive your credit scores in a negative way. And the better your credit, the better the interest rate you're going to be able to receive. So that's important.
Awesome. Okay, so kind of talking more about the property itself, there are a few things that are optional, and one of those is actually getting an inspection on the home. Mortgage lenders like myself and Dave, we don't require that you get an actual inspection on the property aside from an appraisal. That being said, we do we think it's a great idea that you should just kind of figure out what kind of home that you're buying, see if there's any mechanical issues or items that are of concern. And so we definitely expect and hope that people will get a homeowner's inspection. But again, an appraisal is a little bit different than an inspection. And inspection is going to go into depth on perhaps water pressure and looking for termite damage or seeing if your water heater is functioning correctly. But an appraisal is going to primarily be looking at the status of the home and the quality of the build, or the how the home is looking and the status of it, but also the square footage, what the neighborhood looks like. And so there's a lot of things that go into that, including, recent sales of homes in the vicinity that are similar, which is the biggest driving factor for an appraisal. But the reason we want to get an appraisal is to determine if your home is actually a fair market value. We're always excited when people are buying a home and the appraisal comes in higher than the purchase price, because it means that, hey, you're getting a great value and even some inherent equity. But one thing that will cause a problem in your mortgage application is if you're buying it for $250,000, it only appraises for $200,000, because on the lending side we're capped at the lower of the purchase price or the appraised value. And so if the appraised value comes in lower, we have to base our qualifying standards and how much we can lend excuse me, based on that lower value. And so a higher value is always fantastic. As far as the average cost, you can see there, home inspections, they do have a cost to them, but they're well worth it in my opinion. Appraisals are usually a little more in cost, but they do a lot more due diligence and research to figure out the value of your home. As far as who is responsible for those reports, typically the buyer buys an inspection. And then on the appraisal side, we actually don't order the appraisal directly, and neither can the client. The homeowner can't order the appraisal directly as well, just to avoid any influence on the appraiser one way or the other. There's actually a third party that would order that appraisal for us, just to keep the lender and the buyer at a distance, just to make it a fair valuation there. Home inspections usually go pretty quick, a day or two. And then as far as an appraisal, in the busiest times we've seen it taken roughly maybe 2 weeks, 10 to 14 days. And so right now we're getting appraisals pretty quickly, usually within that 5 to 7 business day time frame. I mentioned a few times, but our underwriter or the person responsible for making sure that the application that was submitted matches the documentation that has been provided by the client actually matches and is accurate. And so we're going to be looking at those pay stubs or those bank statements, verifications of employment with your employer, and just use those documents to confirm that what was in the application is legit, and also that there is qualification for the mortgage itself. They're going to review everything and make sure everything works well. And then after, they're going to come back to myself and our assistant and say, hey, we need to get possibly a few more documents just to verify a few factors in the application itself. The main reason for this is we want to make sure that we're being responsible and making sure that we don't lend on a home to somebody that is going to put them in financial dire straits. We want to make sure you can afford the payment, that it's not going to be a financial burden to you. And so we're going to review all those items to make sure that works. The other thing is that the underwriter is going to review the appraisal, make sure that the property is one that is going to work for the loan, that it's appropriate for the loan, and that it's an eligible property, and that the value fits what we're trying to do there. Once the underwriter reviewed everything and is signed off on, yes, this home works, the documentation provided qualifies the borrower, we're to what we call final approval. And this is the best day ever. This is when you get that approval that says that you're done. You probably don't have to submit anything else to your lender, and we can schedule a closing, which is our next slide. So closing is one that, again, is a very exciting day, but this is when we're actually going to sign a number of documents to provide an agreement that you'll repay the loan. We'll actually be closing at a title company. A title company is kind of a third party that is a fiduciary to help with the closing and funding of a loan. And with that, we're going to provide what's called a closing disclosure. That closing disclosure is going to identify and itemize all the finalized costs for the loan itself. And so you know exactly what you need to bring to the table, if any, and you'll know prior, of course, to signing, but that's kind of an important fun day there. So speaking of title companies, what do? The one thing is that we want to make sure that you have a clean title history on the property, and there aren't any encumbrances that would prohibit Academy Mortgage from placing a lien on the property and being in first position. The reason that's important is in the unlikely event that someone would default on a mortgage, we would want to be able to repay our loan through the liquidation of that asset or through the liquidation of the home. But we get a title policy from the title company. This guarantees our lien position. They make sure that the taxes by the seller have all been paid and reconciled. They prepare closing documents. And once you've signed all those documents, they'll actually take them to the county and record them with the county itself. And then they'll distribute all the funds to the seller and to appropriate parties for the sale of the home. So it's kind of nice that they take care of all of that for us. There are a few things that we need to bring to closing. With the Patriot Act, one thing you'll have to bring is a valid form of identification. Usually the driver's license or a government issued ID is going to be sufficient for that. If there are funds that you need to bring to closing, depending on the amount, a check might be fine, but usually anything greater than $5,000 to $10,000 is going to require an actual wire from your bank to the title company. And then there is a possibility of any additional documents, but usually it's limited to your driver's license and then how you're going to pay for your down payment and closing costs. Let's see here. Dave, anything to add to what we've discussed there?
I don't think so. I mean, just the main takeaway from the closing and title is that they are a third party. You know, their job is to make sure that the history on that place is clean. They're going to take the signatures. They're going to transfer the money around so that it can be funded at the end, and they're going to record it with the county so it is in your name when you close. So, you know, the biggest takeaway from this presentation, obviously, is the stuff that Kyle really addressed through the, I would say, the beginning to the middle of it, and that's the stuff you need to do as a new first-time home buyer to be ready. And that's the things to work on there, and just make sure you have a job, make sure you have your job with a decent history. And if you have questions, the biggest thing is call Kyle, call myself, and just, we can answer questions. We can help you get there. If you're not there now, don't think this doesn't apply to you. All this stuff, if you're not there right now, work with us and we will kind of consult with you to make it so you can get to that point. We give you the advice on what it's going to take to get there, to be someone that can be approved.
So we brought up the buzzword a few times of closing costs in conjunction with your down payment as well. And so I want to take a moment and kind of go through what common closing costs really are and why they're there. So we mentioned title insurance just a moment ago. That is actually an insurance policy that's issued by the title company. And there is a fee to that is dependent on the actual loan amount. And so we'll usually ask for a quote for what those are. And then there could be some miscellaneous title charges for title searches, recording, settlement, notary fees, all those kinds of things. On the loan side, typically there are loan processing fees, and this helps cover the cost of the actual creation of your mortgage loan. And so those would be detailed to let you know exactly what those are. Sometimes there's an itemized underwriting fee, and this would again cover the creation of your mortgage as well as administration fees. Typical with a mortgage is prepaid expenses such as your interest, private mortgage insurance, property taxes, and then let's see, what else am I missing here, and home insurance. And so with those are going to be prepaid expenses. They're not necessarily considered fees because they are just prepaid expenses for the expenses you already have with owning a mortgage or owning a home. And so those would be identified on your closing disclosure as well. There may be loan origination fees and discount points. Discount points allow you to actually buy the mortgage rate down with a fee. And so again, like Dave has mentioned several times, if you have any questions, that would be a good one to ask a mortgage lender, like, hey, what does it mean to have a mortgage point, and what does that do to my rate? Usually 1 point equals 1% of your mortgage amount. And so again, a $250,000 mortgage, 1 point is going to be a $2,500 in points. And then that would translate into a reduction in your mortgage interest rate. So one thing that I wanted to hit on was how your mortgage payment is calculated. And so principal and interest is the repayment of your mortgage plus the interest due to your interest rate. But in that mortgage payment, we're also going to collect a portion of your taxes and homeowners insurance. And then there may be private mortgage insurance if there's a limited down payment where you haven't reached that 20% down, which is pretty common. A lot of people have private mortgage insurance for at least the first few years of their home ownership, because coming up to 20% is quite a bit. But with taxes and homeowners insurance, we're usually going to collect about 1/12 of what those expenses are for your taxes and your homeowners insurance, and that will become part of your monthly mortgage payment. Now, I think this is the greatest benefit of having a mortgage payment, is because your taxes and your insurance for your home are going to be automatically collected and paid by your mortgage itself. And so you will never have to worry about paying your property taxes. They'll be taken care of for you. And then your homeowner's insurance, same story. When that comes due, bank would cut a check for your insurance to keep that rolling. So the last step really is the funding of your loan, which is a great thing. It means you've signed all your documents, it's been recorded to the county, and then we would be funding with the title company all the required funds to settle on your purchase. And that usually takes, usually we try to get those funded early so that they're recorded and done by the end of the day that you're signing, or it could be the next day. All right, so close of escrow, essentially, once it's funded and recorded, you're done. You're closed on your home. Everything is great that way. And then the final is that confirmation of recording. So the title company would actually reach out and let the bank, like Academy Mortgage, and the client that's buying, let them know, hey, this is all done. This is recorded. This is your home. And you'll be able to collect your keys, which is a great thing to be able to walk into your home shortly after. So at that point, we congratulate you, and we hope that we'll be able to be of service to you down the road. Rates improve, and when that happens, you want to refinance that mortgage. And refinancing mortgage just simply means that you're going to replace your mortgage that has a slightly higher interest rate with one that is potentially a lower interest rate, and that can save you honestly hundreds of thousands of dollars in moving to a cheaper interest rate. And you'd go right through all the steps that we talked about, but having done your mortgage with Academy Mortgage, you'd have 90% of those documents and items that we already would need. And so the process would be quite simple. And you just have the benefit of a cheaper mortgage payment thereafter. A little bit about Academy Mortgage. Like Dave mentioned, we've been around for a little bit. We're in 49 out of 50 states. And we have constantly been identified as the top 10 in FHA purchase units, top 15 in FHA volume, and top 20 in total purchase volume as well. We're a fantastic company. I joined this company about 4 years ago. It's been one of the best decisions I've made in my career. And plus I get to work with Dave. Dave's awesome. So anyway, Derek, that's about the size of it. Any questions for us?
I don't have any. Give it a minute, see if anyone else has any, but we appreciate you guys going over the overview. I know sometimes, when we're talking to tenants, that home ownership always just feels constantly out of reach. So
Yeah,
able to kind of give a roadmap to help them. So, but really appreciate you guys and your willingness to do this, and we'll keep in touch. So, but with that, we'll let you go. Thanks again.
awesome.
Thank
Thanks.
you.
All right, talk to you later.
Bye-bye.
Bye.